Now here we're going to turn towards Europe and what are some of the things that are happening in that area. So it's no surprise that economic confidence, industrial confidence, services, consumer, all of that continues to move in the wrong direction, moving negative in general. And we don't really see that changing just given, where prices have gone, the pressure that's going to continue to come through, especially when you look at CPI and inflation in general, because CPI month over month was expected to be at negative 0.1%. Instead was at positive 0.1%, again, shifting everything higher. So then when you start looking at GDP was expected to be at 0.2, came in at 0.7, but how much of that was driven by, again, that real versus nominal? And when you start looking at the trends going forward, Eurozone manufacturing was expected to be at 49.6. So in contraction came in at 49.8. So now this is the first contractionary number that we're really starting to see on the manufacturing front. Eurozone services came in at 51.2. So then when you take the composite is just at a slight decline at 49.9. But when you start looking at the pieces to it, so remember, they're still having some of that legacy supply chain issues, which is a positive contributor to the ISM, the PMI numbers. So when you start factoring that in and pulling out the positive contribution, because there's really a negative piece to it, you get an idea that things are a bit worse than really what some of the data is initially saying. PPI, same thing, showing just the pressure there. Month over month was expected to be up 1%, came in up 1.1%. Retail sales was expected to be flat, came in at negative 1.2%. And then year over year was expected to be negative 1.7, came in at negative 3.7%. So that's when you start, again, looking at the different factors where GDP for Q2 eked out some growth. But again, Q3 is in very negative trajectory to the point where it's not only contracting on the manufacturing side, services eked out some growth, but the retail side is now firmly down and confidence is waning, which again is also going to pull down some of the services piece, which is where we see some of those different pressure points. And it's important to put into perspective the Eurozone CPI, where the expectation year on year was 8.7%, came at 8.9%, and just look at how it continues to march up. And when you consider the electricity problems, the natural gas problems, and now you have the Rhine it could be shut down, as we talked about in segment 1, you're starting to see the pressure move back up on cost. And then when you look at availability, as these companies face these huge increases in costs, they're going to have to start doing economic run cuts, which is then going to create more price increases because there will be less supply, which again is going to shift that up. And when you look on the core level, you get an idea of just how fast things have moved. And we see the rate of change, again, some of that kind of petering off with you only had a 10 basis point increase, but it's still an increase, and it's still a problem off of a very high number, which is why we do see more pressure ahead for European inflation, where for the U.S. we think that we're moving much closer to sideways, where we're much closer to stagflation, while Europe is still seeing some of that inflation. Then when you look at the population change, this is a negative when you consider holistically for population growth. This is a negative for production, for economic expansion, and this is going to be one of those bigger overhangs unless you get a bigger increase in immigration to help offset that, because you're not seeing because the total change is still negative in terms of what natural. And again, who is having children? You need at 2.1 child per woman in order to be flat. And then if each woman is having averaging 2.1, obviously you can't have a tenth of a child. So it just has to some people can have 1, some people can have 4. It just needs to average out to that. So you need that average to be 2.1 with immigration to be the delta. Without that, you're going to continue to see a lot of economic headwinds. That is more of a demographic issue than anything else, but needs to be looked at and addressed and just appreciated in terms of what does this mean going forward. Eurozone retail sales volume is now on a real basis. You can see it's now moving firmly negative. We see that moving down further as corporate credit standards continue to tighten. And this is what we've been discussing, where all of this tightening, all of these pressures, you're seeing sales drop. Wages are not reacting the same way in Europe they have in other places. And again, these are things that we don't see changing anytime soon. Change in terms and conditions on loans to households for home purchases. Again, you're seeing those factors shift and how they continue to move. Germany, Spain, Italy have seen the biggest pivot. France continues to be at the much easier level. Then when you look at change in demand for loans to houses for house purchases, even though things as things have tightened, you're seeing that even though France though has kept things a bit easier, you're seeing demand drop in France and continuing to be an underlying problem. And this is when you take it all into perspective, the demand actual versus demand expected. The demand expected is continuing to fall, and as we know, this real estate is a positive contributor to GDP, and so as we go through Q3, we see that slowing down further, putting even more pressure on the underlying economy, and again, more convinced on that slowdown and that recession. Change in terms and conditions on consumer credit and other lending to households. Here you can see that there is some tightening, some easing, depending on what are the different percentages. And when you start looking at the pieces, margins still low in France, increasing in other places. Margins on riskier loans. Again, France continues to be on the easier pace. Changes in terms and conditions on loans or credit lines to SMEs and large enterprises as an aggregate is getting tighter. So even though there's some places that are still a bit looser, when you look at Germany, Spain, Italy, and then other parts of the EU, you're seeing things tighten, and this is going to result in additional slowdowns. Eurozone GDP, just giving you an idea in terms of where it is, it came in positive. Again, we still think that when you factor in the real side of GDP, it was negative, and it's going to continue to be negative as we go into Q3 of this year. Eurozone GDP in terms of billions, again, it's you have to factor in just how aggressive inflation has gotten over this period, and it still was only able to eke out that 0.7. Euro area sentiment indices, you get an idea of just where they are. Households firmly negative, with everything else now moving in the wrong direction. Services kind of flatlining, but the move is, again, the direction is down. German labor costs have risen faster than other countries, but even as they have risen, you have to get an idea of just where inflation is. So even though unit labor costs have gone up, which means people are making a bit more money, it is not resulting in additional spending, because of those pressure points that we discussed and I've highlighted, previously when we're looking at just where is inflation in general. Now, rounding out their own little operation twist. So the defragmentation or fragmentation piece. So when you look at this, the ECB has been buying Italy and Spain and selling Germany, Netherlands, France, because they're trying to, again, keep this consolidated in terms of flatlining, because based on the debt levels and the economic outlooks for both Spain and Italy, the geopolitical uncertainty in Italy, there should be a wider spread between the two. But this is how they're trying to manage that, which is why, and I've had these questions asked before, why hasn't Italian debt moved out wider? This is one of those key pieces that has been that overhang. So then when you start looking at Germany in general and the problems that reside within the country, which is a plethora and getting worse. So CPI was expected at 0.6, came in at 0.9. Import prices still elevated. Again, you're seeing that pressure across the board. Unemployment starting to creep higher a bit. GDP, when you look at it, it was essentially flat. That's something that is, I think, in the GDP SA quarter over quarter is that flat piece. Year over year is a bit different. Retail sales, though, again, those leading pieces back to, even though wages have gone up, you're still not covering inflation. Retail sales was expected to be up 0.3, came in negative 1.6% year over year, came in a negative 9.8. German manufacturing, remember that Germany is a manufacturing powerhouse, especially on the export side, expected at 49.2, came in at 49.3. So right in line with estimates, but now you're in contraction. That's, again, where you're coming, the pressure. And then remember, imports are a leading indicator for exports. Imports were expected to be up 1.3%, came in up 0.2. So that's indicative of not only slowing internal demand, but how exports are going to come under pressure as well. And we've been highlighting that for several months now, especially comparing it to different pieces, both with trade with the U.S. and trade with China, all moving in the negative side. And then German services expected at 49.2, came in at 49.7. But then, again, the overall composite came in at 48, all moving in that negative realm, while factory orders slightly better than expected, but still negative. And it's, and that's, I think, the underlying pressure. And as construction, as we've been talking about, construction has been the biggest overhang in the country. And here, when you look at the expectation, last month it was 45.9, and this month it was 43.7. So you're just moving further and further negative, and that is a big headwind when you're looking at just GDP and growth in general. So survey data weakened further in July. Again, this is where when we're looking at some of those reopening base effects fading out, and German core GDP and PM survey, again, you get an idea of just the direction in which we're heading in. Eurozone manufacturing PMI, again, moving further negative. Industrial production, the output index is now fully in contraction. This is where we just look at the leading indicators, the global backdrop, global trade, and you get an idea of why we are as cautious as we are and as bearish as we are within Europe. In Italy, industrial sales in May slightly better, but remember, June gets worse. GDP came in a bit better than expected. Quarter over quarter was expected to be at 0.3, came in at 1%. But when you look at CPI did come back a bit in Italy, was expected to be negative 0.9, came in at negative 1.1. But as you get some of that contraction, but PPI accelerated. So when you look at PPI, which is it's a leading indicator for where CPI is going. PPI last month was 0.3, came in at 1.1% in June. Year over year, slightly lower, but still moving. Again, you still have the cost going up, so CPI is gonna find some of that movement. Industrial sales slow. Italy manufacturing was expected at 49, came in at 48.5. So again, moving further negative, which is another headwind. Then when you look at Italian service PMI was expected at 50, so slight 50.1, so slight growth. Instead came in at 48.4, pretty steep contraction. So overall, we're now at 47.7. Again, firmly in contraction, firmly in pressure points, and that's something that we don't see changing in terms of the pressure that is afoot and the geopolitical uncertainty in the region. And then retail sales now firmly negative. Last month was up 1.9% or revised 2%, but this month in June was at negative 1.1. Spain retail sales slowing considerably. GDP again eked out some of that growth with CPI expecting to come in at negative 0.3, came in at negative 0.2. So slightly worse, but again, still moving in that direction. While PMI, again, looking at manufacturing, is expected at 50, came in at 48.7. Services did eke out from 52, came in at 53.8. And because that's such a bigger weighting, the composite was still there. So you did get some growth. But when you look at just the weightings in between all of them, Germany being the largest, Italy being larger than Spain, that's, again, you're seeing that pressure overall across the European continent and where we see some of these issues, and then just puts into perspective in terms of the manufacturing across Italy and Spain and why we see the trajectory and, again, that trend moving in the wrong direction. While France PPI was last month was negative 0.3, came in at 1.3%. Again, ratcheting back up. Consumer spending eked out some growth, was expected to be at negative 0.9, came in at 0.2. So that's something that we do see rolling over, but nice to see, but costs are going back up. GDP was expected at 0.2, came in at 0.5, slowly eked out some of that growth, but inflation's also accelerating again. Expected to be at 0.2, came in at 0.3, with when you look at the underlying growth, manufacturing expected to be at 49.6, came in at 49.5. Services slightly better at 53.2, putting in some growth. So that's where you're kind of getting this mixed backdrop. But when you start looking at where prices are going, where prices are now, and where they're going based on electricity demand, electricity pricing, slowdown in industrial capacity because of shortfalls of raw materials to natural gas to electricity in general, the economic run cuts are going to accelerate the deteriorating state of the continent, which we don't see changing, which is why we are very concerned on Q3 through Q4 and well into 2023. So that's what we have for you on Europe. In the next segment, we're going to go deeper into China. But just to be clear, I mean, if you're not short Europe at this point, like I think that there is a lot of opportunity to start picking your spots because things have held in a bit better, and I think that things are going to unhinge very quickly in this region. So now on to Asia.